Hello and welcome. In this course, we will explore financial instruments presentation based on International Accounting Standard 32. Financial instruments have been subject to international accounting guidance for many years. In April 2001, the International Accounting Standards Board adopted IAS 32, which deals with the disclosure and presentation of financial instruments. This standard was originally introduced in 1995 and updated over the years to reflect changes in practice and understanding. In December 2003, the board issued a revised version of IAS 32, consolidating previous guidance and incorporating important clarifications on the classification of financial instruments, treasury shares, and the costs associated with equity transactions. The revisions aim to provide clearer and more consistent rules for presenting and reporting financial instruments. Over the years, IAS 32 has been updated several times to reflect developments in financial reporting. In December 2005, the board moved all disclosure requirements to a separate standard, IFRS 7, leaving IAS 32 focused solely on the presentation of financial instruments. Later, in February 2008, the standard was revised to allow certain puttable instruments and obligations arising on liquidation to be classified as equity. In October 2009, further amendments required some rights denominated in foreign currencies to also be treated as equity. In December 2011, the guidance was clarified to resolve inconsistencies in the criteria for offsetting financial assets and liabilities. More recently, in May 2017, changes associated with IFRS 17 introduced an exemption for treasury shares in specific circumstances. Over time, IAS 32 has been updated through a number of minor amendments made by other standards. These changes were introduced to keep the standard aligned with broader developments in financial reporting and accounting practices. They include updates from improvements to IFRSs, revisions related to consolidated financial statements, joint arrangements, fair value measurement, revenue recognition, leases, hedge accounting, and financial instruments. Each of these amendments ensured that IAS 32 remains consistent with evolving standards, providing clear guidance on the presentation of financial instruments while reflecting the latest accounting practices. IAS 32, which deals with the presentation of financial instruments, is organized into numbered sections and an appendix. Each section carries equal authority, reflecting the original format of the standard when it was adopted. To fully understand IAS 32, it should be considered in the context of its overall objective, the supporting explanations provided in the basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. When specific guidance is not provided, IAS 8 helps in selecting and applying appropriate accounting policies. The main goal of this standard is to provide clear principles for presenting financial instruments as either liabilities or equity, and for determining when financial assets and liabilities can be offset. It guides the classification of financial instruments from the perspective of the issuer, covering financial assets, financial liabilities, and equity instruments, as well as the treatment of related interest, dividends, gains, and losses. The standard also explains the circumstances under which financial assets and liabilities should be presented on a net basis. These principles work alongside the rules for recognizing and measuring financial instruments in IFRS 9 and for disclosing information about them in IFRS 7. This standard applies to all entities and covers all types of financial instruments, with a few exceptions. It does not apply to interests in subsidiaries, associates, or joint ventures that are accounted for under other specific standards. However, if these interests are measured using the rules for financial instruments, the requirements of this standard must be followed. The standard also applies to all derivatives linked to these interests. Additionally, it does not cover employers' rights and obligations under employee benefit plans, which are addressed by a separate standard on employee benefits. This standard does not apply to insurance contracts or certain investment contracts that fall under the scope of IFRS 17. However, it does apply to derivatives embedded in these contracts if separate accounting for them is required, as well as to investment components that are separated from these contracts when separation is required. Additionally, the standard applies to an issuer's rights and obligations under insurance contracts that qualify as financial guarantee contracts, provided the issuer uses the rules for financial instruments to recognize and measure them. If the issuer chooses to account for these contracts under the insurance standard, then the insurance rules take precedence. This standard also applies to an entity's rights and obligations that are financial instruments arising from credit card contracts or similar arrangements, provided the entity accounts for them as financial instruments. It similarly covers financial instruments under insurance contracts that limit compensation to the amount needed to settle the policyholder's obligation, if the entity chooses to apply the financial instrument rules rather than the insurance standard. The standard extends to financial instruments and obligations under share-based payment arrangements governed by IFRS 2, with certain exceptions. It does not cover contracts already addressed under earlier sections, but it does provide guidance on treasury shares that are purchased, sold, issued, or canceled as part of employee share plans or other share-based payment schemes. This standard applies to contracts for buying or selling non-financial items that can be settled in cash, another financial instrument, or by exchanging financial instruments, treating them as if they were financial instruments. The only exception is for contracts held for the entity's expected purchase, sale, or usage requirements. However, the standard does apply to contracts that the entity chooses to measure at fair value through profit or loss. There are several ways such contracts can be settled. They may allow either party to settle in cash, another financial instrument, or by exchanging financial instruments. In other cases, the contract terms may not explicitly allow net settlement, but if the entity has a history of settling similar contracts in this way, whether directly with the counterparty through offsetting contracts or by selling the contract before it is exercised or expires, the standard would still apply. A contract is also within the scope of the standard when an entity has a practice of taking delivery of a non-financial item and then selling it shortly afterward to profit from short-term price changes or dealer margins. Similarly, if the non-financial item can be easily converted to cash, the contract falls under this standard. Such contracts are not considered to be held for the entity's expected purchase, sale, or usage needs, and therefore must follow the rules for financial instruments. Other contracts are evaluated to determine whether they are genuinely held for expected operational purposes, which affects whether the standard applies. Additionally, written options to buy or sell non-financial items that can be settled in cash, another financial instrument, or by exchange are included in the scope, as they cannot be entered into for routine operational purposes. This standard uses specific definitions for key terms. A financial instrument is any contract that creates a financial asset for one entity and a financial liability or equity instrument for another. A financial asset includes cash, an equity instrument of another entity, or a contractual right. This right may allow an entity to receive cash or another financial asset, or to exchange financial assets or liabilities with another party under potentially favorable conditions. It also includes contracts that may be settled in the entity's own equity instruments, such as non-derivative contracts where the entity is or may be required to receive a variable number of its own equity instruments. A financial asset also includes derivatives that may be settled in ways other than exchanging a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. This excludes certain instruments, such as puttable financial instruments classified as equity, instruments that require delivering a share of net assets only on liquidation, or contracts for the future receipt or delivery of the entity's own equity instruments. A financial liability is any liability arising from a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or liabilities under conditions that may be unfavorable to the entity. It also includes contracts that may be settled in the entity's own equity instruments, such as non-derivative contracts where the entity is or may be required to deliver a variable number of its own equity instruments. A financial asset also includes derivatives that may be settled in ways other than exchanging a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. Rights, options, or warrants to acquire a fixed number of the entity's equity instruments for a fixed amount are considered equity instruments if they are offered proportionally to all existing owners of the same class. Certain instruments are excluded, including puttable instruments classified as equity, instruments requiring delivery of a share of net assets only on liquidation, and contracts for the future receipt or delivery of the entity's own equity instruments. In some cases, a financial liability can be classified as an equity instrument if it meets specific features and conditions outlined in the standard. An equity instrument represents a contract that shows a residual interest in the assets of an entity after all its liabilities have been deducted. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants on the measurement date. A puttable instrument is a financial instrument that allows the holder to return it to the issuer for cash or another financial asset, either at their discretion or automatically upon the occurrence of an uncertain event, such as the holder's death or retirement. Several other terms used in this standard are defined in IFRS 9 or IAS 39, including amortized cost, derecognition, derivative effective interest method, financial guarantee contract, and financial liability at fair value through profit or loss. In this standard, the terms contract and contractual refer to agreements between two or more parties that have clear economic consequences and little or no discretion to avoid them, often because they are legally enforceable. These contracts and the financial instruments they represent can take many forms and do not need to be written. Finally, the term entity includes individuals, partnerships, corporations, trusts, and government agencies. When a financial instrument is issued, the issuer must classify it at the time of initial recognition as either a financial liability, a financial asset, or an equity instrument. This classification is based on the substance of the contractual arrangement and the definitions of these terms. To determine whether an instrument is equity rather than a liability, the instrument must meet specific conditions. It should not create any contractual obligation to deliver cash or another financial asset, nor require the exchange of financial assets or liabilities under potentially unfavorable conditions. If the instrument may be settled using the issuer's own equity instruments, it can then be classified as an equity instrument. An equity instrument can be a non-derivative that does not require the issuer to deliver a variable number of its own equity instruments, or a derivative that is settled only by exchanging a fixed amount of cash or another financial asset for a fixed number of the issuer's equity instruments. Rights, options, or warrants to acquire a fixed number of equity instruments for a fixed amount are also considered equity if they are offered proportionally to all existing owners of the same class. Certain instruments are excluded, such as those designed for future delivery or that meet specific liability conditions. A contractual obligation, including one arising from a derivative, that may result in the receipt or delivery of the issuer's equity instruments but does not meet the criteria for equity, is not classified as an equity instrument. However, in some cases, a financial liability can be treated as equity if it meets specific features and conditions defined in the standard. A puttable financial instrument is one that gives the holder the right to require the issuer to repurchase or redeem it for cash or another financial asset. However, such an instrument can be classified as equity rather than a liability if it meets certain conditions. First, it must entitle the holder to a proportional share of the entity's net assets if the entity is liquidated. This share is calculated by dividing the net assets into equal units and multiplying by the number of units held by the instrument holder. Second, the instrument must belong to a class that is subordinate to all other classes, meaning it has no priority over other claims on the entity's assets during liquidation and does not need to be converted into another instrument to be considered subordinate. All financial instruments within a subordinate class share the same characteristics. They must all be puttable, and the method for calculating the repurchase or redemption price is consistent across the class. Besides the obligation to repurchase or redeem the instrument for cash or another financial asset, these instruments do not create any other contractual obligation to deliver cash or exchange financial assets or liabilities under potentially unfavorable conditions. They are also not settled in the entity's own equity instruments. The total expected cash flows from these instruments over their lifetime are primarily determined by the entity's profit or loss, the changes in recognized net assets, or the changes in the fair value of both recognized and unrecognized net assets, excluding the effects of the instruments themselves. For a puttable instrument to be classified as equity, it must not only meet all the previously described features, but the issuer must also have no other financial instrument or contract that significantly affects the residual returns to the puttable instrument holders. Specifically, there should be no other instrument or contract where the total cash flows are largely based on the entity's profit or loss, changes in recognized net assets, or changes in the fair value of both recognized and unrecognized net assets, and which substantially limits or fixes the returns to the puttable instrument holders. When applying this condition, the entity should ignore non-financial contracts with holders of the puttable instrument that have similar terms to contracts that could exist with parties who do not hold the instrument. If the entity cannot confirm that this condition is met, the puttable instrument cannot be classified as an equity instrument. Some financial instruments require the issuing entity to deliver a proportional share of its net assets to another party, but only upon liquidation. This obligation arises when liquidation is either certain and beyond the entity's control, as in the case of a limited life entity, or when it occurs at the option of the instrument holder. Such an instrument can be classified as equity if it meets specific conditions. First, it must give the holder a proportional share of the entity's net assets in the event of liquidation. The net assets are those remaining after all other claims on the entity's assets have been settled. The proportional share is calculated by dividing the net assets into equal units and multiplying by the number of units held by the instrument holder. Second, the instrument must belong to a class that is subordinate to all other classes, meaning it has no priority over other claims on the entity's assets during liquidation. The instrument does not need to be converted into another type to belong to the class that is subordinate to all other classes of instruments. All instruments in this subordinate class must share the same contractual obligation for the issuer to deliver a proportional share of net assets upon liquidation. To be classified as equity, the instrument must also meet an additional condition. The issuer must not have any other financial instrument or contract that significantly affects the residual returns to the instrument holders. Specifically, no other instrument or contract should have total cash flows that are mainly based on profit or loss, changes in recognized net assets, or changes in the fair value of recognized and unrecognized net assets, and that substantially limits or fixes the residual return to the holders. When assessing this condition, the entity should ignore non-financial contracts with holders of the instrument that have terms similar to contracts that could exist with non-holders. If the entity cannot confirm that this condition is satisfied, the instrument cannot be classified as an equity instrument. An entity must classify a financial instrument as an equity instrument once it has all the required features and meets the specified conditions. If the instrument later loses any of these features or conditions, it must be reclassified. For example, if all non-puttable instruments are redeemed and the remaining puttable instruments meet the required features and conditions, the entity should reclassify those puttable instruments as equity from the date of redemption. When reclassifying, an equity instrument that no longer meets the conditions is treated as a financial liability from the date it loses those features. The liability is measured at its fair value at the reclassification date, and any difference between the previous carrying value of the equity and the fair value of the liability is recognized in equity. Conversely, a financial liability that now meets all the features and conditions is reclassified as equity, and the equity instrument is measured at the carrying value of the financial liability at the date of reclassification. Except in certain specific cases, a key factor in distinguishing a financial liability from an equity instrument is whether the issuer has a contractual obligation to deliver cash or another financial asset to the holder, or to exchange financial assets or liabilities under potentially unfavorable conditions. Even though holders of equity instruments may be entitled to a proportional share of dividends or other distributions, the issuer is not contractually required to make these payments because there is no obligation to deliver cash or another financial asset. The classification of a financial instrument in the Statement of Financial Position is determined by its substance rather than its legal form. While legal form and substance are often aligned, this is not always the case. Some instruments may have the legal appearance of equity, but are actually liabilities in substance, and others may combine characteristics of both equity instruments and financial liabilities. A preference share that requires the issuer to redeem it for a fixed or determinable amount at a specified future date, or allows the holder to demand redemption for a fixed or determinable amount, is classified as a financial liability. Similarly, a financial instrument that gives the holder the right to return it to the issuer for cash or another financial asset, known as a puttable instrument, is generally considered a financial liability. This is true even if the redemption amount is determined based on an index or another variable item. The only exception is when such instruments meet the specific criteria to be classified as equity instruments, as outlined in the relevant provisions. Certain types of investment structures, such as open-ended mutual funds, unit trusts, partnerships, and some cooperative entities, may allow their unit holders or members to redeem their interests for cash at any time. When this right exists, the unit holders or members' interests are generally classified as financial liabilities, unless the instruments meet the criteria to be treated as equity. However, being classified as a financial liability does not prevent the entity from using terms like net asset value attributable to unit holders in its financial statements, or from providing additional disclosures to show that total members' interests may include equity items such as reserves and puttable instruments that do not meet the definition of a liability. If an entity does not have an unconditional right to avoid delivering cash or another financial asset to fulfill a contractual obligation, that obligation is considered a financial liability, except for instruments classified as equity. For example, restrictions such as limited access to foreign currency or the need for regulatory approval do not remove the entity's contractual obligation or the holder's right. Likewise, a contractual obligation that depends on the counterparty exercising its right to redeem is also treated as a financial liability because the entity cannot unconditionally avoid delivering cash or another financial asset. A financial instrument may not explicitly require the issuer to deliver cash or another financial asset, but it can create an indirect obligation through its terms. For instance, if a financial instrument includes a non-financial obligation that must be fulfilled only if the entity fails to make distributions or redeem the instrument, and the entity can avoid delivering cash only by meeting that non-financial obligation, the instrument is treated as a financial liability. Additionally, a financial instrument is considered a financial liability if it requires the entity, upon settlement, to deliver cash another financial asset or its own shares whose value substantially exceeds the value of the cash or other financial asset. Even if there is no explicit contractual obligation, the high value of the share settlement option effectively ensures that the entity will settle in cash. In effect, the holder is guaranteed to receive an amount at least equal to the cash settlement option. A contract is not considered an equity instrument just because it may involve the receipt or delivery of the entity's own equity instruments. An entity may have a contractual right or obligation to deliver or receive a number of its own shares that varies so the fair value of the shares equals the amount of the contractual obligation. This amount could be fixed or it could fluctuate based on a variable other than the market price of the entity's equity instruments, such as an interest rate, commodity price, or another financial instrument. For example, a contract that requires the entity to deliver enough of its own shares to equal a value of 100 currency units or to match the value of 100 ounces of gold is considered a financial liability. Even though the entity may settle the contract by delivering its own equity instruments, it is not classified as equity because the entity uses a variable number of shares to settle the contract. Therefore, the contract does not represent a residual interest in the entity's assets after liabilities are deducted. A contract that will be settled by the entity delivering or receiving a fixed number of its own equity instruments in exchange for a fixed amount of cash or another financial asset is considered an equity instrument. For instance, a share option that allows a counterparty to buy a fixed number of the entity's shares for a fixed price or a fixed principal amount of a bond is treated as equity. Changes in the fair value of the contract due to fluctuations in market interest rates, which do not affect the cash, other financial assets, or the number of equity instruments to be exchanged, do not prevent the contract from being classified as an equity instrument. Any consideration received, such as the premium for a written option or warrant on the entity's own shares, is added directly to equity, while any consideration paid, like the premium for a purchased option, is deducted directly from equity. Changes in the fair value of an equity instrument are not recognized in the financial statements. If the entity's own equity instruments that are received or delivered upon settlement are puttable instruments meeting the required conditions, or instruments that obligate the entity to deliver a pro rata share of its net assets only on liquidation and meet the specified conditions, then the contract is classified as a financial asset or a financial liability. This also applies to contracts settled by receiving or delivering a fixed number of such instruments in exchange for a fixed amount of cash or another financial asset. Except in the situations described for those specific instruments, a contract that requires an entity to purchase its own equity instruments for cash or another financial asset creates a financial liability. This liability is measured at the present value of the redemption amount, such as the forward repurchase price, option exercise price, or any other redemption amount, even if the contract itself is otherwise considered an equity instrument. One example of a financial liability is when an entity has a forward contract to purchase its own equity instruments for cash. The liability is initially recognized at the present value of the redemption amount and is reclassified from equity. After initial recognition, it is measured according to IFRS 9. If the contract expires without delivery, the carrying amount of the liability is reclassified back to equity. Even if the obligation to purchase depends on the counterparty exercising a right to redeem, such as with a written put option, it still gives rise to a financial liability for the present value of the redemption amount. Additionally, a contract that will be settled by delivering or receiving a fixed number of the entity's own equity instruments in exchange for a variable amount of cash or another financial asset is classified as a financial asset or liability. For instance, a contract may require the entity to deliver 100 of its own equity instruments in return for an amount of cash equivalent to the value of 100 ounces of gold. Contingent settlement provisions refer to financial instruments that may require the issuer to deliver cash or another financial asset if certain uncertain future events occur. These events are beyond the control of both the issuer and the holder, such as changes in a stock market index, interest rates, taxation requirements, or the issuer's future revenues or debt-to-equity ratio. Since the issuer does not have an unconditional right to avoid delivering cash or another financial asset, the instrument is generally classified as a financial liability. However, there are exceptions. The instrument is not a financial liability if the contingent settlement provision that could require cash or asset settlement is not genuine. The issuer would only need to settle in cash or assets in the event of the issuer's liquidation, or the instrument meets all the features and conditions of a puttable instrument as described in paragraph 16A and 16B. Settlement options arise when a derivative financial instrument gives one party a choice over how it will be settled. For example, the issuer or holder can choose to settle either in cash or by exchanging shares for cash. In such cases, the instrument is classified as a financial asset or a financial liability, unless all settlement alternatives would result in it being an equity instrument. For example, a share option where the issuer can choose to settle net in cash or by exchanging its own shares is a financial liability. Similarly, contracts to buy or sell a non-financial item for the entity's own equity instruments fall within the scope of the standard if they can be settled either by delivering the non-financial item or netting cash or another financial instrument. These are financial assets or financial liabilities, not equity instruments. A compound financial instrument is a non-derivative instrument that contains both a liability and an equity component. The issuer needs to evaluate the terms of the instrument and classify each component separately as a financial liability, a financial asset, or an equity instrument. For example, consider a bond that the holder can convert into a fixed number of ordinary shares. From the issuer's perspective, this bond has two components. The first is a financial liability, which represents the obligation to deliver cash or another financial asset. The second is an equity instrument, which is essentially a call option granting the holder the right to convert the bond into ordinary shares. The economic effect of issuing such an instrument is similar to issuing a debt instrument with detachable share purchase warrants. Therefore, the issuer presents the liability and equity components separately in the statement of financial position. The classification of the liability and equity components of a convertible instrument does not change just because the likelihood of exercising a conversion option changes, even if conversion may appear economically beneficial to some holders. Holders may not always act as expected, since factors like tax consequences can differ among them, and the probability of conversion can change over time. The entity's contractual obligation to make future payments continues until it is extinguished, either through conversion, the maturity of the instrument, or some other transaction. IFRS 9 provides guidance on measuring financial assets and financial liabilities. Equity instruments represent a residual interest in the assets of an entity after deducting all liabilities. When the initial carrying amount of a compound financial instrument is allocated between its equity and liability components, the equity component is assigned the residual amount. This residual is calculated by deducting the amount determined for the liability component from the fair value of the instrument as a whole. Any derivative features, such as a call option embedded in the instrument, are included in the liability component, except for the equity component, like an equity conversion option. The total of the carrying amounts assigned to the liability and equity components when a compound financial instrument is first recognized is always equal to the fair value of the instrument as a whole. This means that no gain or loss arises from recognizing the components separately at initial recognition. Using the approach described earlier, the issuer of a bond that is convertible into ordinary shares first determines the carrying amount of the liability component. This is done by measuring the fair value of a similar liability, including any embedded non-equity derivative features that does not have an equity component. Once the liability component is measured, the carrying amount of the equity component, which represents the option to convert the bond into ordinary shares, is calculated by subtracting the fair value of the liability from the fair value of the compound financial instrument as a whole. When an entity buys back its own equity instruments, these are known as treasury shares and are deducted from equity. No gain or loss is recognized in profit or loss when the entity purchases, sells, issues, or cancels its own equity instruments. Any consideration paid or received for these shares is recorded directly in equity. Treasury shares may be held by the entity itself or by other members of its consolidated group. In some cases, entities operate investment funds, either internally or externally, that provide investors with benefits determined by units in the fund. These entities recognize financial liabilities for the amounts payable to the investors. Similarly, some entities issue groups of insurance contracts with direct participation features and hold the underlying items. In certain situations, these funds or underlying items may include the entity's treasury shares. Even though treasury shares are generally deducted from equity, an entity may choose not to deduct a treasury share that is included in such a fund or held as an underlying item, but only when the entity has reacquired its own equity instruments for these specific purposes. Alternatively, an entity may choose to continue accounting for a treasury share as equity. At the same time, the reacquired instrument can be treated as if it were a financial asset and measured at fair value through profit or loss under IFRS 9. This choice is made on an instrument-by-instrument basis and is irrevocable. For this purpose, insurance contracts include investment contracts with discretionary participation features, as defined in IFRS 17. The amount of treasury shares held must be disclosed separately, either in the statement of financial position or in the notes, following the requirements of IAS 1 on presentation of financial statements. Additionally, if the entity reacquires its own equity instruments from related parties, disclosure must be made in accordance with IAS 24 on related party disclosures. Interest, dividends, losses, and gains that relate to a financial instrument or a component that is classified as a financial liability are recognized as income or expense in profit or loss. In contrast, distributions to holders of an equity instrument are recognized directly in equity. Transaction costs related to an equity transaction are accounted for as a deduction from equity. Any income tax associated with distributions to equity holders or with transaction costs of an equity transaction is accounted for following IAS 12 on income taxes. The way a financial instrument is classified, either as a financial liability or as an equity instrument, determines how interest, dividends, losses, and gains are recognized. For example, dividend payments on shares that are fully recognized as liabilities are treated as expenses, similar to interest on a bond. Gains or losses from the redemption or refinancing of financial liabilities are recognized in profit or loss. However, redemptions or refinancings of equity instruments are recognized as changes in equity. It is important to note that changes in the fair value of an equity instrument are not recognized in the financial statements. When an entity issues or acquires its own equity instruments, it typically incurs various costs. These costs may include registration and regulatory fees, amounts paid to legal, accounting, or other professional advisors, printing costs, and stamp duties. The transaction costs of an equity transaction are recorded as a deduction from equity, but only to the extent that they are incremental costs directly attributable to the equity transaction and would have been avoided otherwise. If an equity transaction is abandoned, the related costs are recognized as an expense. For a compound financial instrument, transaction costs are allocated between the liability and equity components in proportion to how the proceeds from the instrument are allocated. When transaction costs relate to more than one transaction, such as the concurrent offering of shares and a stock exchange listing of other shares, the costs are allocated using a method that is rational and consistent with similar transactions. The total amount of transaction costs deducted from equity in a period is disclosed separately in accordance with IAS 1. Dividends that are classified as an expense may be shown in the statement of profit or loss and other comprehensive income either together with interest on other liabilities or as a separate item. Beyond the rules in the standard, disclosure of interest and dividends must also follow the requirements of IAS 1 and IFRS 7. In some cases, because interest and dividends can differ in matters like tax deductibility, it is useful to disclose them separately in the statement of profit or loss and other comprehensive income. Any tax effects are disclosed in accordance with IAS 12. Gains and losses that arise from changes in the carrying amount of a financial liability are recognized as income or expense in profit or loss, even when the liability includes a right to the residual interest in the entity's assets in exchange for cash or another financial asset. Under IAS 1, an entity presents any gain or loss from remeasuring such an instrument separately in the statement of comprehensive income when it helps explain the entity's performance. A financial asset and a financial liability can only be offset and presented as a net amount in the statement of financial position when the entity currently has a legally enforceable right to set off the recognized amounts and when it intends either to settle on a net basis or to realize the asset and settle the liability at the same time. If a financial asset is transferred, but the transfer does not qualify for derecognition, the entity cannot offset the transferred asset against the associated liability. This standard allows financial assets and financial liabilities to be presented on a net basis only when doing so reflects the entity's expected future cash flows from settling two or more separate financial instruments. When an entity has the right to receive or pay a single net amount and intends to do so, it effectively has only one financial asset or one financial liability. In other situations, financial assets and financial liabilities must be presented separately, reflecting their nature as resources or obligations of the entity. The entity must also provide the disclosures required by IFRS 7 for recognized financial instruments that fall within this scope. Offsetting a recognized financial asset and a recognized financial liability and presenting only the net amount is different from derecognizing a financial asset or liability. When an asset and a liability are offset, no gain or loss is recognized. In contrast, derecognition removes the previously recognized item from the statement of financial position and may also result in recognition of a gain or loss. A right of set-off is a debtor's legal right, whether established by contract or otherwise, to settle or eliminate all or part of an amount owed to a creditor by applying an amount that the creditor owes to the debtor. In rare cases, a debtor might have a legal right to apply an amount owed by a third party against what is owed to a creditor, provided there is a clear agreement among the three parties that establishes this right. Since the right of set-off is a legal right, the conditions supporting it can vary between jurisdictions, and the laws governing the relationships among the parties must be considered. The existence of an enforceable right to set off a financial asset and a financial liability can influence the rights and obligations connected to those items and may also affect an entity's exposure to credit and liquidity risk. However, having the right alone is not enough to justify offsetting. If an entity does not intend to exercise the right or to settle the asset and liability at the same time, the amount and timing of its future cash flows remain unchanged. When an entity does plan to exercise the right or settle simultaneously, presenting the asset and liability on a net basis provides a more accurate reflection of the expected cash flows and the risks associated with them. Simply intending to settle on a net basis without the legal right is not enough because the underlying rights and obligations of each financial instrument stay the same. An entity's intentions about settling specific assets and liabilities may be influenced by its usual business practices, financial market requirements, or other factors that limit the ability to settle net or simultaneously. When an entity has a right of set-off but does not intend to settle net, or to realize the asset and settle the liability at the same time, it must disclose the effect of that right on its credit risk exposure, according to IFRS 7. Simultaneous settlement of two financial instruments can happen, for example, through the operation of a clearinghouse in an organized financial market or through a face-to-face exchange. In these cases, the cash flows are effectively equivalent to a single net amount, and the entity is not exposed to credit or liquidity risk. In other situations, an entity may settle two instruments by receiving and paying separate amounts, which exposes it to credit risk for the full value of the asset or liquidity risk for the full value of the liability. These risk exposures can be significant, even if they are brief. Therefore, the realization of a financial asset and the settlement of a financial liability are considered simultaneous only when the transactions occur at exactly the same moment. The conditions for offsetting are generally not met, and offsetting is usually inappropriate in certain cases. For instance, when several different financial instruments are used to replicate the features of a single financial instrument, often called a synthetic instrument, offsetting is not suitable. Similarly, when financial assets and financial liabilities arise from instruments that have the same primary risk exposure, such as a portfolio of forward contracts or other derivatives, but involve different counterparties, offsetting is also usually not appropriate. Sometimes financial or other assets are pledged as collateral for financial liabilities that are non-recourse, meaning the creditor can only claim the collateral and not other assets of the debtor. In other situations, financial assets may be set aside in a trust by a debtor to discharge an obligation, without the creditor formally accepting those assets as settlement. An example of this is a sinking fund arrangement. Similarly, obligations that arise due to events causing losses may be expected to be recovered from a third party under an insurance claim. Entities that carry out multiple financial instrument transactions with a single counterparty may enter into what is called a master netting arrangement. This type of agreement allows for a single net settlement of all financial instruments covered by the agreement if there is a default or termination of any one contract. These arrangements are commonly used by financial institutions to protect against losses in case a counterparty becomes unable to meet its obligations, such as in bankruptcy or other financial difficulties. When an entity carries out multiple financial instrument transactions with a single counterparty, it may enter into what is called a master netting arrangement with that counterparty. This type of agreement allows all the financial instruments covered by the arrangement to be settled as a single net amount if there is a default or if any one contract is terminated. Financial institutions commonly use these arrangements to protect themselves against losses in case a counterparty cannot meet its obligations, such as in bankruptcy or other financial difficulties. Typically, a master netting arrangement creates a right of set-off that only becomes enforceable after a specified event, such as a default, or under other circumstances that are not expected to occur during normal business operations. Importantly, a master netting arrangement cannot be used as a basis for offsetting unless specific criteria are met, as outlined in paragraph 42. When financial assets and financial liabilities covered by a master netting arrangement are not offset, the entity must disclose the impact of the arrangement on its exposure to credit risk in accordance with IFRS 7, paragraph 36. The standard must be applied by entities for annual periods starting on or after January 1, 2005, although earlier application is allowed. However, an entity cannot apply the standard to periods beginning before January 1st, 2005, unless it also applies IAS 39, including the amendments issued in March 2004. If an entity chooses to apply this standard for an earlier period, it must disclose that fact. In February 2008, the amendments known as puttable financial instruments and obligations, arising on liquidation, updated IAS 32 and IAS 1. These amendments require that financial instruments with all the features and conditions described in paragraph 16A and 16B or paragraph 16C and 16D be classified as equity instruments. The amendments also modified several paragraphs, including 11, 16, 17 through 19, 22, 23, 25, AG 13, AG 14, and AG 27, and added new paragraphs such as 16, A through 16, F 22A, 96B, 96C, 97C, AG 14A through AG 14J, and AG 29A. Entities must apply these amendments for annual periods beginning on or after January 1st, 2009. Early application is permitted, but if an entity does so, it must disclose that fact and apply the related amendments to IAS 1, IAS 39, IFRS 7, and IFRIC 2 at the same time. The amendments on puttable financial instruments and obligations arising on liquidation introduced a limited scope exception. This means that an entity cannot apply the exception by analogy to other instruments. The classification under this exception is limited to the accounting of the instrument under IAS 1, IAS 32, IAS 39, IFRS 7, and IFRS 9. The instrument is not considered an equity instrument under other guidance, such as IFRS 2. This standard is applied retrospectively. IAS 1, as revised in 2007, updated the terminology used throughout the IFRSs and also amended paragraph 40. Entities are required to apply these amendments for annual periods beginning on or after January 1st, 2009. If an entity chooses to apply IAS 1, revised 2007, for an earlier period, it must apply the amendments for that earlier period as well. IFRS 3, Business Combinations, as revised in 2008, deleted paragraph 4C. Entities are required to apply this amendment for annual periods beginning on or after July 1st, 2009. If an entity applies IFRS 3, revised 2008, for an earlier period, the amendment must also be applied for that period. However, this amendment does not apply to contingent consideration arising from a business combination where the acquisition date preceded the application of IFRS 3, revised 2008. In such cases, the entity accounts for the consideration in accordance with paragraphs 65A to 65E of IFRS 3, as amended in 2010. When applying the amendments described in paragraph 96A, an entity is required to split a compound financial instrument that has an obligation to deliver to another party a pro rata share of the net assets of the entity only on liquidation into separate liability and equity components. If the liability component is no longer outstanding, a retrospective application of these amendments to IAS 32 would involve separating two components of equity. The first component would be recorded in retained earnings and represent the cumulative interest that had accrued on the liability component. The second component would represent the original equity component. Therefore, if the liability component is no longer outstanding at the date of application of the amendments, the entity does not need to separate these two components. Paragraph 4 was amended by the improvements to IFRSs issued in May 2008. Entities are required to apply this amendment for annual periods beginning on or after January 1st, 2009, although earlier application is permitted. If an entity applies the amendment for an earlier period, it must disclose that fact and also apply for that earlier period the related amendments to paragraph 3 of IFRS 7, paragraph 1 of IAS 28, and paragraph 1 of IAS 31 as issued in May 2008. Entities are also permitted to apply the amendment prospectively. Paragraphs 11 and 16 were amended by the classification of rights issues issued in October 2009. Entities are required to apply this amendment for annual periods beginning on or after February 1st, 2010. Earlier application is permitted, and if an entity applies it for an earlier period, it must disclose that fact. Paragraph 97B was amended by the improvements to IFRSs issued in May 2010. This amendment must be applied for annual periods beginning on or after July 1st, 2010, and earlier application is also permitted. IFRS 10 and IFRS 11 on joint arrangements issued in May 2011 amended paragraphs 4A and AG 29. Entities are required to apply these amendments when they apply IFRS 10 and IFRS 11. IFRS 13, issued in May 2011, amended the definition of fair value in paragraph 11 and also amended paragraphs 23 and AG 31. Entities must apply these amendments when they apply IFRS 13. Finally, the presentation of items of other comprehensive income, which amended IAS 1 and was issued in June 2011, changed paragraph 40. Entities must apply this amendment when they apply IAS 1 as revised in June 2011. The Offsetting Financial Assets and Financial Liabilities Amendments to IAS 32, issued in December 2011, deleted paragraph AG 38 and added paragraphs AG 38A to AG 38F. Entities are required to apply these amendments for annual periods beginning on or after January 1, 2014, and they must be applied retrospectively. Earlier application is permitted. If an entity applies these amendments from an earlier date, it must disclose that fact and also make the disclosures required by the disclosures. Offsetting Financial Assets and Financial Liabilities Amendments to IFRS 7, which were issued in December 2011. The amendments to IFRS 7, issued in December 2011, changed paragraph 43 by requiring entities to disclose the information required in paragraphs 13b to 13e of IFRS 7 for recognized financial assets within the scope of paragraph 13a. These amendments must be applied for annual periods beginning on or after January 1, 2013, including interim periods within those annual periods, and the disclosures are to be applied retrospectively. The annual improvements for the 2009 to 2011 cycle, issued in May 2012, amended paragraphs 35, 37, and 39 and added paragraph 35A. Entities are required to apply these amendments retrospectively, in accordance with IAS 8 on accounting policies, changes in accounting estimates and errors for annual periods beginning on or after January 1, 2013. Earlier application is permitted, and any early application must be disclosed. The Investment Entities Amendments to IFRS 10, IFRS 12, and IAS 27, issued in October 2012, amended paragraph 4. Entities are required to apply this amendment for annual periods beginning on or after January 1, 2014. Earlier application is permitted, and if an entity chooses to apply it early, it must also apply all other amendments included in investment entities at the same time. IFRS 15, Revenue from Contracts with Customers, issued in May 2014, amended paragraph AG 21. Entities are required to apply this amendment whenever they apply IFRS 15. IFRS 9, as issued in July 2014, amended multiple paragraphs including 3, 4, 8, 12, 23, 31, 42, 96C, AG2, and AG30, and deleted paragraphs 97F, 97H, and 97P. Entities must apply these amendments when they adopt IFRS 9. IFRS 16, Leases, issued in January 2016, amended paragraphs AG9 and AG10. Entities are required to apply these amendments when they apply IFRS 16. IFRS 17, issued in May 2017, amended paragraphs 4, AG8, and AG36, and added paragraph 33A. Further amendments to IFRS 17, issued in June 2020, also amended paragraph 4. Entities must apply these amendments whenever they adopt IFRS 17. This standard replaces IAS 32 on financial instruments, disclosure and presentation, as revised in 2000. It also supersedes several interpretations, including ESIC 5, which dealt with the classification of financial instruments with contingent settlement provisions, ESIC 16, which covered share capital and reacquired own equity instruments, also known as treasury shares, and ESIC 17, which addressed the costs of an equity transaction. In addition, this standard withdraws the draft SIC interpretation D34, which concerned financial instruments or rights that are redeemable by the holder. The appendix provides application guidance and is considered an integral part of IAS 32 on financial instruments presentation. It explains how to apply specific aspects of the standard. However, the standard itself does not cover the recognition or measurement of financial instruments. Those requirements, including how to recognize and measure financial assets and liabilities, are set out in IFRS 9. Currency or cash is considered a financial asset because it serves as the medium of exchange and forms the basis for measuring and recognizing transactions in financial statements. Similarly, a deposit of cash with a bank or a similar financial institution is a financial asset, as it gives the depositor a contractual right to withdraw cash or to draw a check against the balance to settle a financial liability. Common examples of financial assets that represent a contractual right to receive cash in the future, along with the corresponding financial liabilities representing an obligation to deliver cash, include trade accounts receivable and payable, notes receivable and payable, loans receivable and payable, and bonds receivable and payable. In all these cases, one party's right to receive cash or obligation to pay cash is directly matched by the other party's corresponding obligation or right. Another type of financial instrument is one where the economic benefit to be received or given up is a financial asset other than cash. For example, a note payable in government bonds gives the holder the contractual right to receive those bonds, while the issuer has the obligation to deliver them. The bonds themselves are financial assets because they represent obligations of the issuing government to pay cash. Therefore, the note is considered a financial asset for the holder and a financial liability for the issuer. Perpetual debt instruments, such as perpetual bonds, debentures, or capital notes, typically give the holder the contractual right to receive interest payments at fixed dates extending indefinitely into the future. These instruments may have no right to receive a return of principal, or the principal repayment may be highly unlikely or scheduled far in the future. For instance, an entity may issue a financial instrument requiring it to make annual interest payments in perpetuity at a stated rate of 8% on a principal amount of 1,000 currency units. Assuming 8% reflects the market interest rate at issuance, the issuer has a contractual obligation to make a stream of future interest payments with a fair value of 1,000 currency units on initial recognition. In this case, the holder holds a financial asset and the issuer holds a financial liability. A contractual right or obligation to receive, deliver, or exchange financial instruments is considered a financial instrument itself. A chain of these contractual rights or obligations also meets the definition of a financial instrument if it ultimately results in receiving or paying cash or in acquiring or issuing an equity instrument. The exercise of a contractual right or the fulfillment of a contractual obligation may be absolute, or it may depend on a future event. For example, a financial guarantee gives the lender a contractual right to receive cash from the guarantor, and the guarantor has a corresponding obligation to pay if the borrower defaults. These rights and obligations arise from a past transaction or event, such as the assumption of the guarantee, even though their exercise depends on a future event, in this case, the borrower defaulting. Contingent rights and obligations like these qualify as financial assets and financial liabilities, even if they are not always recognized in the financial statements. Some of these contingent contracts may fall under the scope of IFRS 17. A lease generally gives the lessor the right to receive and the lessee the obligation to pay, a series of payments that are very similar to the combined principal and interest payments under a loan agreement. For a finance lease, the lessor accounts for the investment in the payments it expects to receive, rather than the underlying asset itself. In this way, a finance lease is considered a financial instrument. Under IFRS 16, however, a lessor does not recognize its right to receive payments under an operating lease. Instead, the lessor continues to account for the underlying asset itself, rather than any future amounts due under the contract. Therefore, an operating lease is not treated as a financial instrument except for individual payments that are currently due and payable by the lessee. It's important to note that physical assets, such as inventories, property, plant, and equipment, as well as right-of-use assets and intangible assets like patents and trademarks, are not financial assets. While controlling these assets can create opportunities to generate cash or other financial assets in the future, they do not give rise to a present right to receive cash or another financial asset. Assets like prepaid expenses, where the future economic benefit comes from receiving goods or services rather than a right to cash or another financial asset, are not considered financial assets. In the same way, items such as deferred revenue or most warranty obligations are not financial liabilities, because the outflow of economic benefits involves delivering goods or services rather than a contractual obligation to pay cash or another financial asset. Liabilities or assets that are not based on contracts, such as income taxes imposed by governments, are also not financial liabilities or financial assets. Accounting for income taxes is covered under IAS 12. Similarly, constructive obligations, which are defined in IAS 37 as provisions, contingent liabilities, and contingent assets, do not arise from contracts and are therefore not financial liabilities.
Equity instruments include things like non-puttable ordinary shares, certain puttable instruments, some instruments that require the entity to deliver a pro rata share of its net assets only on liquidation, certain types of preference shares, and warrants or written call options that allow the holder to subscribe for or purchase a fixed number of non-puttable ordinary shares in exchange for a fixed amount of cash or another financial asset. When an entity has an obligation to issue or purchase a fixed number of its own equity instruments for a fixed amount of cash or another financial asset, that is considered an equity instrument of the entity. However, if a contract also includes an obligation to pay cash or another financial asset, it creates a liability for the present value of the redemption amount. For example, an issuer of non-puttable ordinary shares takes on a liability when it formally decides to make a distribution and becomes legally obliged to the shareholders. This could happen after declaring a dividend or during a liquidation, when any remaining assets after satisfying liabilities are distributed to shareholders. Additionally, if an entity acquires a purchased call option or a similar contract that gives it the right to require a fixed number of its own equity instruments for a fixed amount of cash or another financial asset, this is not considered a financial asset of the entity. Instead, any consideration paid for such a contract is deducted directly from equity.
One of the features described in paragraphs 16a and 16c is that the financial instrument belongs to a class that is subordinate to all other classes. To determine whether an instrument is in this subordinate class, an entity evaluates the instrument's claim on liquidation, as if the liquidation were to happen on the date when the instrument is classified. The entity must reassess the classification if there is a change in relevant circumstances. For instance, if the entity issues or redeems another financial instrument, this could affect whether the instrument in question remains in the subordinate class. An instrument that has a preferential right on liquidation is not considered an instrument with an entitlement to a pro rata share of the entity's net assets. For example, an instrument may provide the holder with a fixed dividend on liquidation in addition to a share of the net assets, whereas other instruments in the subordinate class, which have a right to a pro rata share, do not have this fixed preferential right. Finally, if an entity has only one class of financial instruments, that class is treated as if it were subordinate to all other classes. The total expected cash flows of an instrument over its life must be substantially based on the profit or loss, or on changes in the recognized net assets, or the fair value of both the recognized and unrecognized net assets of the entity during the life of the instrument. Profit or loss and changes in the recognized net assets should be measured in accordance with the relevant IFRSs. A holder of a puttable financial instrument, or an instrument that requires the entity to deliver a pro rata share of its net assets only on liquidation, may engage in transactions with the entity in a capacity other than as an owner. For example, the holder might also be an employee. When assessing whether the instrument should be classified as equity under paragraph 16a or 16c, only the cash flows and contractual terms that relate to the holder in their role as an owner are considered. For instance, in a limited partnership with limited and general partners, some general partners may provide guarantees to the entity and receive remuneration for doing so. These guarantees and the associated cash flows relate to the general partners as guarantors, not as owners. Therefore, such guarantees are not taken into account when determining whether the general partner's instruments are subordinate to the limited partner's instruments, and they are disregarded when assessing whether the contractual terms of the partnership instruments are identical. Another example involves profit or loss sharing arrangements that allocate profit or loss to instrument holders based on services provided or business generated in the current or previous years. These arrangements are considered transactions with the holders in their role as non-owners and should not be taken into account when assessing the features listed in paragraph 16A or 16C. However, if a profit or loss sharing arrangement allocates profit or loss to instrument holders based on the nominal amount of their instruments relative to others in the same class, this represents a transaction with holders in their role as owners. In that case, it should be considered when assessing the features in paragraph 16A or 16C. Furthermore, the cash flows and contractual terms of any transaction between an instrument holder acting as a non-owner and the issuing entity must be comparable to an equivalent transaction between the entity and someone who is not an instrument holder. For a financial instrument that otherwise meets the criteria in paragraph 16A or 16C to be classified as equity, one condition is that the entity does not have any other financial instrument or contract that both bases its total cash flows substantially on the profit or loss, or the changes in recognized or unrecognized net assets, and at the same time substantially fixes or restricts the residual return to the instrument holder. Some types of instruments, when entered into on normal commercial terms with unrelated parties, are generally unlikely to prevent an instrument from being classified as equity. These include instruments whose total cash flows are based substantially on specific assets of the entity, instruments whose cash flows are based on a percentage of revenue, contracts designed to reward individual employees for services rendered, and contracts that require the payment of only an insignificant percentage of profit for services or goods provided. Derivative financial instruments are a type of financial instrument alongside primary instruments like receivables, payables, and equity instruments. Examples of derivatives include options, futures, forwards, interest rate swaps, and currency swaps. Derivatives create rights and obligations that transfer one or more financial risks from one party to another. When a derivative is first entered into, it gives one party a contractual right to exchange financial assets or liabilities under potentially favorable conditions, or a contractual obligation to exchange them under potentially unfavorable conditions. Derivative financial instruments generally do not transfer the underlying primary financial instrument when the contract is first entered into, nor is such a transfer guaranteed at maturity. Some derivatives include both a right and an obligation to make an exchange. The terms of the exchange are set at the start of the contract, so as market prices change, these terms may become favorable or unfavorable. For example, a put or call option on financial assets or liabilities gives the holder a right to receive potential future economic benefits from changes in the fair value of the underlying instrument. The writer of the option, in turn, takes on an obligation to forego those potential benefits or bear potential losses. The holder's right is a financial asset, and the writer's obligation is a financial liability. The financial instrument underlying an option can be any financial asset, such as shares or interest-bearing instruments. Sometimes, the option may require the writer to issue a debt instrument instead of transferring a financial asset. However, if exercised, the underlying instrument is a financial asset for the holder. The holder's right to exchange the asset under potentially favorable conditions and the writer's obligation to exchange it under potentially unfavorable conditions are separate from the underlying financial asset itself. The characteristics of the holder's right and the writer's obligation are not affected by whether the option is likely to be exercised. Another example of a derivative financial instrument is a forward contract. Suppose a purchaser agrees to pay CU1,000,000 cash in exchange for CU1,000,000 fixed-rate government bonds in 6 months, while the seller agrees to deliver the bonds in exchange for the cash. During those 6 months, both parties hold a contractual right and obligation to exchange the instruments. If the market price of the bonds rises above CU1 000,000, the contract is favorable for the purchaser and unfavorable for the seller. If the price falls below CU1 000,000, the opposite applies. In a forward contract, the purchaser holds a contractual right, like a call option, and a contractual obligation, like a written put option. The seller, conversely, holds a contractual right, like a put option, and a contractual obligation, like a written call option. These rights and obligations are financial assets and liabilities that are separate from the underlying instruments, such as the bonds and cash to be exchanged. Unlike options, where exercise is at the holder's choice, both parties in a forward contract are obliged to perform at the agreed time. Many derivatives create rights or obligations to make future exchanges. Examples include interest rate and currency swaps, interest rate caps, collars and floors, loan commitments, note issuance facilities, and letters of credit. An interest rate swap is like a forward contract, but instead of a single exchange, the parties agree to a series of future cash exchanges, one based on a floating interest rate and the other on a fixed rate. Futures contracts are another type of forward contract, but they are standardized and traded on an exchange. Contracts to buy or sell non-financial items are not financial instruments. This is because they give one party the right to receive a non-financial asset or service, and the other party the obligation to deliver it without involving cash or another financial asset. For example, options, futures, or forward contracts on commodities like silver are not financial instruments. Many commodity contracts fall into this category, and some are standardized and traded on organized markets, similar to financial derivatives. For example, a commodity futures contract can often be bought or sold for cash because it is exchange-traded and frequently changes hands. However, the buyers and sellers are essentially trading the underlying commodity. The ease of trading, cash settlement possibilities, or negotiability does not change the contract's fundamental nature. It remains a non-financial contract. That said, some contracts to buy or sell non-financial items can fall under this standard if they are settled net, exchanged for financial instruments, or if the non-financial item is readily convertible to cash. Except where IFRS 15 revenue from contracts with customers applies, a contract involving the receipt or delivery of physical assets does not create a financial asset for one party and a financial liability for the other unless payment is deferred beyond the transfer of the assets. For example, buying or selling goods on trade credit does create a financial asset and liability. Some contracts are linked to commodities but do not involve physical delivery. Instead, settlement is made in cash according to a formula in the contract. For example, a bond's principal may be calculated based on the market price of oil at maturity, applied to a fixed quantity. Even though the principal depends on a commodity price, the cash settlement makes this contract a financial instrument. The definition of a financial instrument also includes contracts that give rise to a non-financial asset or liability in addition to a financial asset or liability. Often these contracts give one party an option to exchange a financial asset for a non-financial asset. For example, an oil-linked bond may give the holder the right to receive fixed interest payments and a fixed cash amount at maturity, with the option to exchange the principal for a set quantity of oil. The desirability of exercising this option depends on the fair value of oil compared to the bond's exchange price. However, the bondholder's intentions regarding the option do not change the substance of the assets involved. The financial asset for the holder and the financial liability for the issuer mean that the bond is a financial instrument, regardless of any other non-financial components. Presentation, liabilities and equity, no contractual obligation to deliver cash or another financial asset. Preference shares can carry different rights. To determine whether a preference sharer is a financial liability or equity, the issuer examines the specific rights attached to the share to see if it creates a present obligation to transfer financial assets. For instance, a preference share that must be redeemed on a set date or at the holder's option is a financial liability because the issuer is obligated to transfer financial assets to the shareholder. However, if the issuer cannot fulfill the redemption due to lack of funds, statutory limits, or insufficient profits, the obligation still exists. Conversely, if the redemption is at the issuer's discretion, there is no present obligation, and the share is not a financial liability. An obligation only arises when the issuer chooses to exercise that redemption option, typically by formally notifying shareholders. When preference shares are non-redeemable, their classification depends on the other rights attached to them. To determine whether they are a financial liability or an equity instrument, the substance of the contractual arrangements is assessed against the definitions of financial liability and equity. If distributions to holders, whether cumulative or non-cumulative, are at the discretion of the issuer, the shares are classified as equity instruments. The classification is not affected by a history of making distributions, nor by any intention to make distributions in the future. It is also not influenced by a possible negative impact on the price of ordinary shares if distributions are not made, the amount of the issuer's reserves, the issuer's expected profit or loss, or the ability of the issuer to influence the amount of its profit or loss for the period. Settlement in the entity's own equity instruments can be illustrated with a few examples. A contract that will be settled by the entity receiving or delivering a fixed number of its own shares for no future consideration, or by exchanging a fixed number of its own shares for a fixed amount of cash or another financial asset, is classified as an equity instrument. Any consideration received or paid for such a contract is added directly to or deducted directly from equity. One example of this is an issued share option that gives the counterparty the right to buy a fixed number of the entity's shares for a fixed amount of cash. However, if the contract requires the entity to purchase or redeem its own shares for cash or another financial asset at a fixed or determinable date or on demand, the entity must also recognize a financial liability for the present value of the redemption amount. An exception applies to instruments that meet all the features and conditions described in paragraphs 16A and 16B or in paragraphs 16C and 16D. One example of a financial liability in this context is an entity's obligation under a forward contract to repurchase a fixed number of its own shares for a fixed amount of cash. An entity's obligation to purchase its own shares for cash creates a financial liability for the present value of the redemption amount, even if the number of shares to be repurchased is not fixed, or if the obligation only arises when the counterparty chooses to exercise a right to redeem. Exceptions to this rule are covered in paragraphs 16A and 16B or 16C and 16D. For example, a conditional obligation could arise from an issued option that requires the entity to repurchase its own shares for cash if the counterparty exercises the option. Similarly, a contract that will be settled in cash or another financial asset is treated as a financial asset or financial liability, even when the amount to be received or delivered depends on changes in the market price of the entity's own equity. Again, exceptions are provided in paragraphs 16A and 16B or 16C and 16D. An example of this type of contract is a net cash-settled share option. A contract that will be settled in a variable number of the entity's own shares, where the total value equals a fixed amount or an amount based on changes in an underlying variable such as a commodity price, is treated as a financial asset or a financial liability. For example, a written option to buy gold, if exercised, may be settled net in the entity's own instruments, with the entity delivering as many of those instruments as equal the value of the option contract. This type of contract is considered a financial asset or financial liability, even if the underlying variable is the entity's own share price instead of gold. Similarly, a contract that will be settled in a fixed number of the entity's own shares, but where the rights attached to those shares are varied, so that the settlement value equals a fixed amount, or an amount based on an underlying variable, is also a financial asset or a financial liability. Contingent settlement provisions are treated in a specific way. Paragraph 25 states that if a part of a contingent settlement provision could require settlement in cash or another financial asset, or in another way that would make the instrument a financial liability, but that part is not genuine, it does not affect how the instrument is classified. For instance, a contract that requires settlement in cash or a variable number of the entity's own shares only if an event occurs that is extremely rare, highly abnormal, and very unlikely to happen, is still considered an equity instrument. Similarly, if settlement in a fixed number of the entity's own shares is contractually prevented in situations outside the entity's control, but those situations have no genuine possibility of occurring, the instrument can still be classified as equity. When preparing consolidated financial statements, an entity presents non-controlling interests, which are the interests of other parties in the equity and income of its subsidiaries, in accordance with IAS 1 and IFRS 10. When deciding how to classify a financial instrument or a part of it in these consolidated statements, the entity takes into account all terms and conditions agreed between members of the group and the holders of the instrument. This helps determine whether the group as a whole has an obligation to deliver cash or another financial asset, or to settle the instrument in a way that would require it to be classified as a liability. When a subsidiary within a group issues a financial instrument and a parent or another group entity enters into additional agreements directly with the holders, such as providing a guarantee, the group may not have discretion over distributions or redemption. While the subsidiary can classify the instrument in its individual financial statements without considering these additional terms, the consolidated financial statements take them into account. This ensures that the statements reflect all contracts and transactions made by the group as a whole. If there is such an obligation or settlement provision, the instrument or the part of it affected by the obligation is classified as a financial liability in the consolidated financial statements. Some types of instruments that create a contractual obligation for the entity are classified as equity instruments under paragraphs 16A and 16B, or 16C and 16D. This classification is an exception to the usual principles in this standard for classifying instruments. However, this exception does not apply to non-controlling interests in consolidated financial statements. Therefore, instruments that are classified as equity under these paragraphs in separate or individual financial statements but are non-controlling interests are classified as liabilities in the consolidated financial statements of the group. Paragraph 28 applies only to issuers of non-derivative compound financial instruments and does not address compound instruments from the holder's perspective. The classification and measurement of financial assets that are compound instruments from the holder's perspective are dealt with under IFRS 9. A common example of a compound financial instrument is a debt instrument with an embedded conversion option, like a bond that can be converted into ordinary shares of the issuer without any other embedded derivative features. Paragraph 28 requires the issuer to present the liability and equity components separately in the statement of financial position. The liability component represents the issuer's obligation to make scheduled interest and principal payments and exists until the instrument is converted. When initially recognized, the fair value of the liability component is calculated as the present value of the contractually determined future cash flows, discounted at the market interest rate for similar instruments that provide substantially the same cash flows on the same terms, but without the conversion option. The equity component of a compound financial instrument is the embedded option to convert the liability into the issuer's equity. This option has value at initial recognition, even if it is out of the money. When a convertible instrument is converted at maturity, the entity D recognizes the liability component and recognizes it as equity. The original equity component remains within equity, although it may be moved between different line items. There is no gain or loss recorded upon conversion at maturity. If an entity extinguishes a convertible instrument before maturity through early redemption or repurchase, and the original conversion rights remain unchanged, the entity allocates the consideration paid and any transaction costs between the liability and equity components at the date of the transaction. The allocation method mirrors the original allocation used when the instrument was first issued, in line with the requirements of paragraphs 28 to 32. Once the allocation of the consideration is made, any resulting gain or loss is accounted for according to the component it relates to. The portion of the gain or loss that relates to the liability component is recognized in profit or loss, while the portion of the consideration relating to the equity component is recognized directly in equity. An entity may also amend the terms of a convertible instrument to encourage early conversion. This could include offering a more favorable conversion ratio or providing additional consideration if the instrument is converted before a specified date. When such amendments occur, the difference between the fair value of the consideration the holder receives under the revised terms and the fair value they would have received under the original terms is recognized as a loss in profit or loss. An entity's own equity instruments are not recognized as a financial asset, no matter the reason they are reacquired. When an entity buys back its own shares, those shares are deducted from equity. However, if the entity is holding its own shares on behalf of someone else, such as a financial institution holding shares for a client, this creates an agency relationship. In this case, the shares held on behalf of others are not included in the entity's statement of financial position. Let's look at an example to explain how this works for a compound financial instrument. Imagine a non-cumulative preference share that must be redeemed for cash in 5 years. Before the redemption date, the entity may choose whether or not to pay dividends. In this case, the instrument is considered a compound financial instrument. The liability component is the present value of the redemption amount. The unwinding of the discount on this liability is recorded in profit or loss and treated as interest expense. Dividends that are actually paid relate to the equity component, so they are recognized as a distribution of profit or loss. The same treatment applies if redemption is optional for the holder or if the share is mandatorily convertible into a variable number of ordinary shares, calculated to equal a fixed amount or an amount based on changes in an underlying variable, such as a commodity. However, if any unpaid dividends are added to the redemption amount, the entire instrument becomes a liability. In this situation, all dividends are treated as interest expense. A right of set-off can either be available immediately or depend on a future event. For example, the right might only be exercisable if one of the counterparties defaults, becomes insolvent, or goes bankrupt. Even if the right is not contingent on a future event, it may only be enforceable under certain circumstances, such as during normal business operations or in the event of default, insolvency, or bankruptcy of one or more counterparties. To satisfy the criterion for a legally enforceable right of set-off, the entity must currently hold that right. This means the right cannot depend on any future event, and it must be enforceable in all of the following situations: in the normal course of business, in the event of default, and in the event of insolvency or bankruptcy of the entity and all counterparties involved. The nature and extent of a right of set-off, including any conditions for exercising it and whether it would remain in place in the event of default, insolvency, or bankruptcy, can differ depending on the legal jurisdiction. Therefore, it cannot be assumed that a right of set-off is automatically available outside the normal course of business. For instance, the bankruptcy or insolvency laws in some jurisdictions may limit or even prohibit the right of set-off in certain situations. To determine whether a right of set-off is enforceable, the laws that govern the relationships between the parties must be considered. This includes the contractual provisions, the laws governing the contract, and any default, insolvency, or bankruptcy laws that apply to the parties. These factors help establish whether the right of set-off is enforceable in normal business operations, in the event of default, and in cases of insolvency or bankruptcy of the entity or its counterparties. To meet the criterion in paragraph 42b, an entity must intend either to settle on a net basis or to realize the asset and settle the liability at the same time. Even if the entity has a right to settle on a net basis, it may still choose to realize the asset and settle the liability separately. If the entity can settle amounts in a way that is, in effect, equivalent to net settlement, it meets the net settlement criterion. This is possible only if the gross settlement system has features that eliminate or result in insignificant credit and liquidity risk and processes both receivables and payables in a single settlement cycle. For example, a gross settlement system would meet the net settlement criterion if the financial assets and financial liabilities eligible for set-off are submitted at the same point in time for processing, and once submitted, the parties are committed to fulfilling the settlement obligation. The system must ensure that once the assets and liabilities have been submitted for processing, there is no potential for the cash flows to change, unless the processing itself fails. If the assets and liabilities are collateralized with securities, they must be settled through a securities transfer or similar system, such as delivery versus payment, so that if the transfer of securities fails, the processing of the related receivable or payable will also fail, and vice versa. Any transactions that fail will be re-entered for processing until they are successfully settled. Settlement must occur through the same institution, such as a settlement bank, a central bank, or a central securities depository. Additionally, an intraday credit facility should be in place to provide sufficient overdraft amounts to enable the processing of payments on the settlement date for all parties, and it must be virtually certain that this facility will be honored if called upon. The standard does not give special treatment to what are sometimes called synthetic instruments. These are groups of separate financial instruments that are acquired and held together to emulate the characteristics of another instrument. For example, combining a floating rate long-term debt with an interest rate swap, where floating payments are received and fixed payments are made, creates the effect of a fixed rate long-term debt. Each of the individual financial instruments that make up a synthetic instrument has its own contractual rights or obligations, with its own terms and conditions. Each instrument can be transferred or settled separately, and each is exposed to risks that may differ from the risks affecting the other instruments in the group. As a result, when one instrument in a synthetic arrangement is an asset and another is a liability, they are not offset against each other and presented on a net basis in the statement of financial position unless they meet the offsetting criteria described in paragraph 42. International Accounting Standard 32, which covers financial instruments disclosure and presentation, and was revised in 2003, was approved for issue by 13 out of the 14 members of the International Accounting Standards Board. Mr. Leisenring dissented, and his dissenting opinion is included after the basis for conclusions. The board members at the time were Sir David Tweedy, who served as chairman, Thomas E. Jones as vice chairman, Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. In February 2008, the International Accounting Standards Board issued the amendments to IAS 32 and IAS 1 regarding puttable financial instruments and obligations arising on liquidation. These amendments were approved by 11 of the 13 board members. Professor Mary E. Barth and Mr. Robert P. Garnett dissented, and their opinions are included after the basis for conclusions. The board members at the time included Sir David Tweedy as chairman, Thomas E. Jones as vice chairman, Mary E. Barth, Stephen Cooper, Philippe Dangeau, Jan Engstrom, Robert P. Garnett, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, John T. Smith, Tatsumi Yamada, and Weiguo Zhang. In October 2009, the International Accounting Standards Board issued the amendment to IAS 32 concerning the classification of rights issues. This amendment was approved by 13 of the 15 board members. Messrs. James J. Leisenring and John T. Smith dissented, and their opinions are included after the basis for conclusions. The board members at the time included Sir David Tweedy as chairman, Stephen Cooper, Philippe Dangeau, Jan Engstrom, Patrick Finnegan, Robert P. Garnett, Gilbert Gellard, Amaro Luis de Oliveira Gomes, Prabhakar Kalavacherla, James J. Leisenring, Patricia McConnell, Warren J. McGregor, John T. Smith, Tatsumi Yamada, and Weiguo Zhang. In December 2011, the International Accounting Standards Board issued the amendments to IAS 32 concerning the offsetting of financial assets and financial liabilities. This amendment was approved by all 15 members of the board. The board members at the time included Hans Huger Vorst as chairman, Ian McIntosh as vice chairman, Stephen Cooper, Philippe Dangeau, Jan Engstrom, Patrick Finnegan, Amaro Luis de Oliveira Gomes, Prabhakar Kalavacherla, Elke Koenig, Patricia McConnell, Takatsugu Ochi, Paul Pachter, Daryl Scott, John T. Smith, and Weiguo Zhang. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.